exclusive conversation this morning is with Ugro Capital. Mr. Shachindra Nath, who's on a buying spree, is with us in the studio. He's the founder and MD, of course, of Ugro Capital. Harsh is also joining in for this conversation. It's a space that he tracks very closely. Mr. Nath, very good morning.
Thank you.
And so you've added to your shopping cart and a largish size purchase there. Tell us about the acquisition.
Yeah, we have not been on buying spree. I think so in terms of the size and scale. Last year we did a small fintech acquisition, and this is the second one. We are largely an organic build over the last 3.5 years. We have been actually looking at an opportunity for consolidation. The consolidation which can, as you know, that our built out has been over the last 3.5 years. We've been seeing what is the most effective utilization which can improve our operating leverage. In last 2.5 years, we have added roughly around 200 plus physical location, 3,000 plus people, and obviously that has increased our OPEX quite significantly. And if we felt that if we can utilize our capital to increase the operating leverage, then in short to medium term, you know, the ROEs and ROEs would improve dramatically.
Sure. But on Profectus, and then just for, context for our viewers who are coming in, you're acquiring Profectus, just the size of it and why this particular acquisition target. Can you take us through that?
Yeah, it's an interesting question. As you know that our aspiration is to build a dedicated MSME financing business. Number one, there are not many lenders which are only for MSME. Most of the lenders are diversified lenders. People do vehicle, consumer, PL, also MSME financing. So the assets to find which are only in MSME are aligned to our objective are very rare. Number two, the way we are seeing the market, majority of the assets which are available either are in unsecured businesses, and our view is that in next 1.5 to 2 years, lower ticket size unsecured businesses like microfinance company would undergo severe pain because there is an over leverage at the customer level which has happened. And that's why second objective is to find assets which are more secured in nature and which can also give more balanced portfolio for us. In that domain, actually Profectus fit fairly well. Incidentally, the story is in year 2016, I and Actis worked together to set up an NBFC. I then decided to do it on my own, and Actis decided to set this up with Mr. K.V. Srinivasan. So I have known this asset also, its culture, its DNA, how it has been built, and 3 of its line of business completely aligns with us, what we do. So that's why we have a great opportunity to bring massive operational synergy. It should add to roughly around 140 crore of cash profitability to us. And if you think of it, to deploy a 1,400 crore of capital which we have raised in loan asset leads to roughly around 4% of origination cost. Now, the same capital deployed without any net worth erosion would give additional 150 crore of profitability. So between the two choices, this was a great choice for us.
You're saying between the two choices of growing organically versus buying this, you're saying this was a better choice for you?
Yeah, so if you buy something which actually erodes the net worth, actually because we are preserving our capital very significantly, our whole purpose of raising capital was to shore up our capital adequacy last time when we did that. So there were twin objectives. Buy something which can add to your capital adequacy net worth. It improves the profitability on immediate basis. When I say immediate, is obviously lag effect of 12 months, and also it improves your quality of the portfolio and secured asset. So on all 3 counts, this fit fairly well.
But Mr. Nath, the other question that comes in, and of course, I mean, you've thought through this acquisition, so I'm not doubting that. But you've raised capital. The Reserve Bank of India has done what it has done. The tailwinds are in favor of the sector. Growing organically without an acquisition, could that have been not such a great idea? Why this acquisition at the current valuations when you've also diluted capital at a lower valuation for yourself?
Of course. No, this is a great question. So you are right. So we raised our capital to achieve our organic growth. So we were at 19.4% at the end of March, and we maintained roughly around 18% of capital adequacy. The way we were growing, we would have ended up back at almost 22% at the end of FY26. That is not changing for us. That growth in focus on our emerging market, which is low ticket LAP and embedded financing, continues. So we are not, changing that. This acquisition actually does not deplete our capital. So we've added 3,500 crore of asset. We would end up at 21 percent of capital adequacy. So think of this way, if we would have done everything organically, we would have ended at around 15,000 odd crores. We would have been at 22% of capital adequacy. But now we have added 3,500 crore of asset. We've added roughly around 150 crore of profitability, but we have not eroded the capital.
21%. Okay, just one quick follow-up. I'm sorry, Harsh. Just one quick follow-up. What happens to growth? I mean, are there some numbers that you're forecasting as a result of this for, say, 26, 27?
So we are trying to, now we will try to do two things. Our organic growth continues in the same momentum as it was doing. We will probably try to recalibrate our organic growth down by 10%. Not that we don't want to do it. What we have seen that our cost of borrowing has remained elevated vis-a-vis our peer set. We believe that our cost of borrowing is 150 basis points higher than any of our competitive set. The reason for that is that we are a very high growth company and we don't have the patience to say no to lenders and reduce our cost of borrowing. So sometimes between the choice of high growth versus reducing cost of borrowing, we'll focus on reducing the cost of borrowing. This acquisition would give us that capacity because we have done in terms of the asset growth on an inorganic basis, which means that if we grow 10% lesser to our organic plan, we will be able to at least bring down cost of borrowing by 50 basis points.
So, two quick questions with regard to Profectus. I want to first ask you, the top line number didn't grow very significantly. Give us some color on that and give us some color also on asset quality because that wasn't part of the disclosure. So, give us some perspective on both of those.
So, Profectus, so as you know, Ugro has 4 lines of businesses, what we call the prime business, prime lab and prime business loan. We have a machinery business, we have an emerging market micro lab, and we have an embedded financing. 3 lines of Profectus business are exactly same. So they are in a prime lab, machinery and supply chain financing. Unlike us, wherein we have 70% secured and 30% business loan, which is guaranteed by credit guarantee, Profectus is a 100% secured portfolio. So 90% of their portfolio is roughly around 14% yield secured lab business in 29 locations. So their portfolio quality actually on a headline basis is better than us. They are at around 1.4% of gross NPA and 1.1% of net NPA. And given that they are in secured yield, largely lab business, their portfolio quality in current market would be far superior than most of their players. If you look at the private market, not the public market, businesses which are in this segment of the market actually trades very attractively. Profectus, the challenge have been that they have built a large base of cost structure, but they have remained in low yielding business. So it's fairly simpler. They, their entire portfolio yield is around 14%. Cost of borrowing is 10.5. So on standalone basis, they are at a 0.9% ROA and 2.5% ROA business. So for anyone to look at on their number, it would not look very attractive.
Correct.
But when we look at it, so at their 30 crore PAT, we would add back around 115 crore because we have an ability to take out the cost because 3 lines of business which are common. So 29 branches which are common locations, only 1 branch would run. A lot of other origination costs, technology, people costs would get, now operationally, reduced. So we looked at this as not as a 30 crore PAT business. We looked at it as a 140 crore PAT business because as an acquirer of this business, their 30 crore PAT would get added back with 115 crore, which we will be able to take out over a period of once acquisition get completed.
Correct me if I'm wrong here. Does this mean that your ROA inches above the 3% mark in FY26 itself for Ugro consolidated now with this acquisition?
So we have very clearly said that this, on a consolidated basis on FY26, it will depend upon when the RBI gives approval, when this becomes our subsidiary and how much time it takes to, to consolidate this to us. But if I take rolling 12 months, or if you look at 26 and 27, this acquisition would enhance our ROA by at least 0.7%. So whatever is our target of ROA, that would get enhanced by between 0.6 to 0.7%. This would also give opportunity for Ugro to improvise its cost structure because the base of asset is much larger. So definitely we think, so our target for FY27 is to reach 4% of ROA. I think so we should be able to fast track that by at least 5 to 6 months.
we just come to the part about fundraise and especially about CCDs? And we've reported recently IIAS had some concerns regarding the whole route taken on those fundraise, the 12.5% paid on coupons. What is, your response to those concerns that a watchdog for shareholders has raised?
Yeah, I was quite surprised that for a small company like us, that I think it's quite heartening to see that IS also kept a focus on us. Not necessarily they do it for all the companies, but they did it for some special purposes. But leaving that aside, IS normally is followed by institutional investor. Unfortunately for us, there is hardly any institutional investor for us. We are still, one of the target is to increase our institutional penetration, because UGRO has been fairly successful in raising capital from private sources, private equity, to sovereign fund. But leave that aside, I think so the way to look at about it, when we ended March 2026, we were at 19.4%. All of our lender covenants are at roughly at around 18% of capital adequacy. If we didn't raise capital, roughly around 2,000 crores worth of our loan would have breached not the regulatory capital norm, but would have breached lender's covenant. In lending business, if you breach a lender's covenant, it can create a very massive cycle of loan recall, stopping the disbursement. You have to cut the operating costs. So company had two choices: to raise capital on an immediate basis. Now, I could have raised that capital, or board could have decided to raise this capital from new investors, or you could have gone back to the existing investors who have already put the money. Now, all our investors are professional financial investors. So we felt that the best option to raise capital is to go to the people who have already invested in warrants. They have some money already deployed, and negotiate them and bring the capital back. When you do that, then obviously they will ask for, what is best for them. UGRO during last 1.5 years, its lowest has gone all the way up to 148 rupees, and peak is at 308 rupees. So investor looked at and protecting their risk, that where it can go below. And that's why they negotiated a commercial construct that how much we have to pay if they have to bring that capital upfront. Company tried negotiating better terms. So obviously we agreed that we will pay you, total coupon, which was commercially negotiated. But we tried reducing that coupon and saying that these investors should not get the double benefit, that they should take a very high coupon from us. Then if the share price, improves, then they also exercise the warrant, and they take the benefit of lower price and also take the benefit of, the warrant conversion. And that's why we linked, saying that we are happy to pay you an upfront coupon to bring the capital now, but we don't want to pay you the second tranche of coupon if you happen to also exercise the warrant. And that's why we linked it. So that was the logic. Second question was that it should not be a bad deal for minority shareholders. Yes. Because the minority shareholder may say that you have given a preferential treatment to one set of shareholder, what about us? The incremental dilution, when we diluted at 265 to 185, was 4% of the company. Exactly for that 4%, we did a right issue. And on the right, we exactly offer the same discount. So we did 185 rupees of preferential allotment, 12.5% of upfront discount, which is coupon. And that's why we did a right at 185 minus 12.5% with 162, matching the same size. We never needed to do right issue. The right issue was done to match the same dilution, so that every shareholder also have the right to put the capital. And that's why some of the large shareholder put capital in the right issue itself.
Okay. Well, we've run out of time, so we'll have to come back on more on this. But thank you so much, Mr. Nath, for coming down and answering all our questions.